Alright, you guys, so this video might be a little bit longer, and I'm going to go over the macro view for the upcoming year and some of the core concepts to look for, and then I'll go over a few trades and talk a little bit about January and February. And so to kind of get you up to speed, we had the Fed, the FOMC meeting. That's where Powell comes out and they actually uh, made the right rate hike. That was 0.5% on the rate hike. Everybody knew that, and so the important part when I'm trading is trading the actual press conference. And I'm not going to talk about that now, but maybe later how to trade those those news events. And I've done a lot of that before, but I keep learning. And so the thing to pay attention to is that everybody looks at the stuff with the Fed and they're waiting for a pivot. And you can see that in the charts that every time there's a rumor of a pivot, which means that the Fed will begin the quantitative easing and, and the tightening process, you see this big rally. And what Powell said was all about, there's two factors. One, it's all about data, and he really doesn't care where the market goes, which is something that in the past he needs it to sell off. I have my theories on why he would say that, but what to watch for in the upcoming year, and especially January, February, March, are these jobs numbers. So what's going to be important is right here. You can see the unemployment rate was unchanged. So this is you can go find this information here, and the only part that's really important for the market is this. And so while the jobs numbers, the market needs to get the cheap money, what they need is for there to be layoffs, to keep it real simple. So they need more people. So a lot of people would think, oh my gosh, everybody's getting laid off, the market's going to go down. It's inverse of that. So what the market needs to see is the jobs numbers come down, more people unemployed. And what that means is at that point, then the Fed is accomplishing its goal of the tightening, the market contracting, the GDP contracting, which results in layoffs. And so then the market says, okay, we're getting more people unemployed, so that means we're going to get the cheap money again because the Fed is going to cut rates. So that's what they're waiting for. And the data points always are changing. And so in the upcoming year, what is going to be the catalyst for big swings in the market is going to be this jobs number. So anytime there's a jobs number coming out, you want to pay attention, and you need to see this, the number of unemployed go up in a significant way. Whereas when we're bouncing between 3.5 and 3.7, the market reacts, but it's not enough to create a Fed pivot, right? So that's what's going to cause the Fed pivot is the jobs numbers ultimately. Okay, so to pay attention to that is really important. Now, the other thing is what they call the summary of economic projections. They call it SEP. Now, if you look at this, is called the dot plot. So you'll hear a lot of people talk about the dot plot, right? Now, in 2022, so we're closing out 2022, and they have what's called the terminal rate. And the terminal rate is the level at which the Fed is expected to stop raising interest rates. With Wednesday's hike, the Fed funds target rate is now 3.75 to 4. So that's 2022, right? So we're there now. See, to 4. So they were actually a little bit high. Okay, and so each one of these dots represents a person on the Fed weighing in. Imagine them like little heads. These are little people here. And so this is where all the people on the Fed are kind of weighing in, right? Each one of these would have a name assigned to it. And so you can see now 2022 is over. Most of the Fed members, the chair people, came in at this from 4 to 4.5. Okay, but that year's concluded. Important for the upcoming year, and what happened, the two key takeaways were from the FOMC were about the jobs numbers. We need to see what they call the difference between a soft landing and a hard landing. What that means is how many people are going to lose their jobs and how quickly. They know people got to lose jobs, but how many, how quickly is what they mean. A hard landing is what we're heading towards, but they don't want to say that. And if you pay attention, they've already so much as said, FedPal has said that the likelihood of a soft landing is less and less. So I want you to pay attention to this column here. It's 2023. Okay, so this is the dot plot, right, for the terminal rate, which means where they're expected to go to. And back here in 2022, myself, I said they're going to have to raise above 5 to 5.25. So now the chair people, they knew this. It's not like they go home, go to bed. They know what I'm talking about, but they can't say that publicly. But now you can see here. So look, you have these members, all of the members now. If these were little heads, little people, all these people walked over. They walked up here, and now they walked over this line. Okay, so these are your members now, and when they talk, they say, most of them are talking, oh, we've got to go to this 5. We've got to come in, and the terminal rate at its peak will be 5. That's what they're saying, and they said that in this past meeting. So this is a significant change from what they were saying before. Okay, so that's really important. So as the year, these are macro. So as the year unfolds, this is something to pay attention to. And you can see 5.5, and my number was 5.25, is what they're going to have to go to. So these little heads are going to end up having to go up here later on. And then we'll see, and some of these heads might go up here, and we'll see, because they don't know, no one knows, because you're living in these kind of macro factors. And as you've heard me talk throughout the year, macro at this point is very even in June we had the 60 of the world's greatest economists, air quotes, and all but one missed on the CPI, which is how high is inflation. Okay, so you can see that. So that's what to pay attention to in the upcoming year. These are going to be major macro signals that are going to signal a Fed pivot, right, that everybody's so anxious for. So if you look at the SPY, the SPX, right, I'm just going to show you this overall trend and try to give you an idea of where we're at today and where we might be heading for in January, where we'll be, and then February, March, and kind of in the macro overview. So you can see this. Oh, this is my short play. Hold on, I got to flip over to here. All right, so this is your top in August. I'll go through the whole thing real quick just to show you. So this is January 2022. Let's do the 5-year real quick. All right, so this will give you a better idea. So this was your COVID crash. The cheap money started to come in, all the stimulus, and then they continued with the stimulus, and we have this huge cheap money pump, this mega bubble. And I've covered that extensively, but this is your top, was in Monday in 2022. Okay, and since then you've been in this downtrend, and you can see top, top, top. You feel me? Okay, and this is on a weekly. So what happened here is we came into another top in November, and what's important, I'm going to go down to I'll show you this on the hourly. So when I say hourly, what that means is each one of these candles, if it's green, that's an hour of bullishness or people buying, and then if it's coming down, that's more supply coming into the market, so that's selling, and each one of these represents an hour of time. Okay, and so what you see is this is on the Monday, this is Tuesday morning, coming into Monday, and then Tuesday morning we had the gap up. So this is your close on Monday, and Tuesday we had this gap up, which means you see how there's no candle here, it's just empty space. Note there's no bar. This is called a candle. So there's no bar here. That's a gap. And so what happened was the market got very bullish coming into the meeting. The news came out and it sold off. It didn't like that news. All right. So when you look at the overall macro trend on the S&P, which is the SPY, you can see on the macro what happened. We came into this trend line and we sell off. And again, you came into the trend line, you sell off. You wicked above. That's that big volatile move. And then we sold off. So where does that lead us now in coming into January? As a macro pattern and based on the earnings reports and some of the larger news, you have 1, 2, and you would get a third bottom in this macro trend. Okay, so this has been my target area. This chart is over a year old. Now I've probably had this line that says target up for a year. And so when the market bottoms, the S&P should bottom around this target, which means that you have coming into January, maybe late January, February, a move to the downside. It's not going to look like a straight line down. It's going to come up and down and up and down, but it will bottom. It should bottom somewhere in this range. And that's kind of a big range, but I'll show you why I think that. So if we go back here, and you can see that this is COVID, and this is 2020. Some companies are trading at their 2019 levels. Okay, they're trading at these levels, but the overall market is not. So it won't be until the overall market is trading at 2019 levels. This is very rudimentary. If you pick up what I'm putting down, try and keep it real simple. But the most of the market needs to come down and bottom around these 2019 levels for there to be what they call long, big buying coming in, not just algorithms and some of these other weirder trades that come in. So on the macro, that's what you're looking for, is this idea is right now I shorted here. I'll play that short. I'll probably buy and short and sell and do all kinds of weird shit in here. But the idea overall is that we're heading now in this downtrend, and this downtrend will lead us to 1, 2, 3, and then a bottom. And what's going to happen is, and your opportunity is one that I'm telling you this ahead of time, and it's all going to be data-driven news catalyst, right? But as the market sells off and hits this bottom coming into March, it's going to take some time. So to get clear on this, it might hang out in here for a week or two, and then some news catalyst or some earnings report come out in February, and when you get these earnings reports in February, now that could send it to its final leg lower. So the overall trend might look something more like this. So here, and what I anticipate is we may come down to this 369 level, bounce, probably come into this level, sell off. You see, so it takes time. The next sell off will be deeper, probably around here, bounce, come up to this level-ish, maybe wick above it. You see? And now we're getting into like February or late January is around here. You're starting to bottom. People are getting really scared. Bounce. Earnings reports hit. So now we're hitting in the first week of February. And it's going to take one of these earnings reports, like Apple would be one. They come out, Netflix, one of these big FANG stocks, and that sends the market lower because these earnings reports are going to be shitball because the Forex, which means that and I talked about this a lot in the summer, U.S. companies for this last quarter, they have to be paid in U.S. dollars. But if you look at what happened with the pound, so if we are selling Netflix in Europe, or and you're using the pound, you're getting paid in pounds. But as this number, you see how it's heading up now? But as this happened down, now our Forex, our exchange rate is very poor. So still, even though Europe's not financially, this was financial disaster. They had to act immediately, or else that's another story. You probably heard the story. This was a big deal here. This happened, I think, September, October. But so during this period of time, when these companies are going to report, it's lagging, right? So they're going to report on these numbers coming into the next year. And so that's on their books, right? They had this shitty exchange rate, and they've had a shitty exchange rate because if you go back, it shouldn't be there, right? So Netflix has always been getting paid pretty well from their guys paying in pounds. Now that happens all over the world. So this is just one example of exposure. Japan had the same issue, right? So all over the world in the upcoming earnings reports, you're going to see that reflected. And my guess, barring other news catalysts like nuclear war or something, that's a news catalyst. These are data catalysts. The data catalyst from what's happening with Forex on top of broken supply chains, on top of money tightening in the U.S. on people spending for Christmas, that's all going to get reported right around this February. I'm going to put a line there, so remember me saying this shit. So around here, February 20, this week here, this is perfect. See, I even drew it. I'm drawing so many of these. It's pretty much just going to look like that. And you're going to see around this period of the end of February, you probably see a bounce, and people are going to get bullish. And then one of these shitty reports is going to come out on a big company, and the market's not going to like it. And it might not, and it will not likely, because they're going to keep coming out, and it's going to drive the market lower, and then you have your bottom. What does that mean? That means at this bottom, so if you're setting up for a more investment style and you're not day trading or swing trading or some of these other concepts, and a lot of people, I'm going to talk about the fear that people have and you know, some of the shit to learn in life. This is going to be a buy. And the reason is a lot of people, everybody who's retail trader, mom and dad, they're all going to get extremely fearful here. Okay? Because they don't understand what the market, and people are like always pissed off unless they you know, have a political affiliation in a certain way. They're always looking at, you know, the top 1%. And what the story will be is, look at all these Wall Street people making all this money while everybody else is losing their jobs. Well, the Wall Street people are making their money because you're losing your job, yeah. But with that, they're making the money because the Fed is going to make money cheap again, let credit be cheap again, ease up on that stuff. And the market's like a heroin addict, like the most spirit of addiction. It's crazy. So on an actual pivot, not a rumor of a pivot, this is a rumor of a pivot. These are rumors. Just look at what the market does on the idea, on a news article being like, oh, the Fed might pivot up 3-6% in a week, right? So on an actual pivot, you're going to see this bounce. Early spring, And it's not going to shoot just, it's not going to be a straight line up, of course, but you're going to see this move over the spring and into the summer. It's going to surprise, and there's going to be these stories, and depends on what you know. But you're going to see all this hatred for the stock market as coming into the summer. The stock market through spring and summer comes close to either its high and making a lower high, and or the market breaks and makes a higher high in the macro pattern leading into August. And so you ride this, and this is where a bunch of loot can be made if this plays out, which it probably will on this Fed pivot. The timing might change because there's so many different data facts, but once this Fed eases a bit, the market is going to go bananas. Everybody who's been wrecked, and crypto people and all these people who think it's, I got so much to say about these things, but they're calling for Armageddon and the end of the world. Yes, that's coming, and I'll show you when, but it is not coming in the spring and summer of 2023. The market will break either to a lower high or a higher high. Now, what then happens is after the Fed has eased and the people, so this is the people are losing their jobs here. It's a sick world, I know. Sick world. Everybody's losing their jobs and the market's doing this. Okay, but why are they losing their jobs? Because demand is coming down, right? So as demand comes down, that's called demand destruction. Okay, so these companies are pumping. Everybody in the market's going to be buying. The market, then everybody's like, we're in a recession. And yes, we are, but the market is not. It's complex shit. I'm trying to keep it simple, but the market is not. The market will move into recession in August, September. The people who have lost jobs here, that's demand destruction. Now the output from those companies, because people are losing their jobs here in the spring, they start to report their earnings in the fall, reporting these lower numbers, and that's where you have a contraction in a big way. And this is the big daddy. This we don't know about, but this is the one the doomsdayers are talking about. I'm a doomsdayer, I believe, but I want to be smart about it. And this is the big daddy. This is where you break on this. And this is, I have this yellow line down here for a reason, I'm sure. Yeah, because you see these lows, that's December 18, and it could go lower, to be honest. I have these lines down here. It depends on, this would be normal, but we don't have a normal world right now. We got these reptilians running things and trying to create a new world order and all this shit. So market conditions would show you that, you'll be able to tell at the time what are the reptilians doing. I don't know, but I mean, I have a pretty good idea. But this move here, now in basic economics, what that would be is it should come out to be about 60%. Right here, you're at 51%. So a retracement, 51%, right? And if we go down, because my line's a little off, I bet you this will come out around 60%. So let me just move this line to show you. Okay. So this, and this is an estimated top based on other things I've thought about and done. But this would probably come out to be around 60%. 56%. So your retracement on the macro coming into end of 2024 would be the market is now down close to between 50 and 60%. And then 2024, now you've entered into a true bear market recession, and things just kind of dick around like this. And then 25, 20, and then you get the new bull market, and shit is, back off to the races, barring all the other things. So, you can look at it and go, what about, digital currency? So I want to talk about one idea just to show you, so you pick up what I'm putting down. When I'm saying this, it's not that I don't understand all the things that can happen. I understand them better than anyone else that I talk to or know, to be honest. So I'm going to show you something on gas, because as you go through YouTube, you're going to see, if you subscribe to certain ideas and concepts, which are correct, you're going to see things like diesel shortage was the last one. And people are like, going to be a diesel shortage, And I said, there is more of a chance of a comet hitting the Earth than there being an actual diesel shortage. That was supposed to happen probably 3 weeks ago. We were going to run out of diesel. 25 days. We had 25 days for no diesel. And all you have to do is go over to the one. This is oil volatility. So let's go to something simple. So these are oil futures, okay? If there was going to be a diesel shortage, if you don't think the market would be positioned and ready to take advantage of that, you got shit in between the ears. You're just not seeing. You're not informed. The market would be positioned. They would be so ready and want it so bad that this market would have been going crazy in here, and there was no movement. So people on YouTube, they say this stuff on YouTube, and it's like, I shouldn't say shit between your ears, because you're critically thinking, but you're not looking at the right information, right? So I take that back. You're critically thinking, but you're not looking. You're looking at someone's opinion. You're not looking at the price action, and these things are determined by money. So that's why I use the charts, because the charts will show us, is that news that I'm being told about the world, us running out of diesel, is that accurate? If it were accurate, we would see that reflected, because there's no one more greedy than a futures oil trader. They would be on that shit. Go watch Billions. You know what I'm saying? They would be on that shit. So when you see these stories, yes, could we run out of diesel? Well, could we? Yeah. But when we do, if that starts to happen, I'm going to see it here first. What's the other story? Oh, get your money out of the banks. So then you see YouTube, and it's like, get your money out of the banks now. Get your money out of the banks now. I'm going to maybe do this real quick. So let's go to, let's say savings. Yeah, savings. Sorry, guys. I should have had this up, but I just thought of this. Savings rate. All right, guys. So if I'm a bank, if I'm New World Order, and believe me, they are doing crazy stuff, and yes, it's all happening, but you got to know when to time it. So this is what they will pay you on your money. Now, the average YouTuber goes, they're just regurgitating shit. So if I'm a bank, if I'm a reptilian, and I want to get your money, I want to start this digital currency, I want to do all this, I want your deposits. How do I get you to do that? Well, I got to pay you on your deposit. I want your savings. These accounts, this is historically low and insulting. They could easily raise this rate and get people to dump money into their accounts, especially at a time of uncertainty. So this should tell you something. The real financial system, or this matrix financial system, they don't want your money in savings right now. They don't care. And the reason they don't care is because these banks get paid interest on Federal Reserves. So they don't give a shit about your savings, right? And logically, inflation, what does that mean? There's too much money in the system. There's too much paper in the system. So they don't want your worthless paper. They don't care. You can go get it. And people are like, well, I couldn't get $20,000. Try to close my account. That's basic business practice. You cannot go to a bank and get 20 grand out. They're like, well, they didn't have it. No, I've done that. I withdrew 20, 30, during COVID, man, I think I took like 30 some out, So, but I had to go to different banks. I mean, I hustled and I had to make phone calls and you can't just get it all at once. So know what's going on. Now, this number reflects the bank's intentions with your savings. They intend to pay you nothing and they don't want your cash, right? So if I wanted to snatch everybody's cash, the first thing I would do is say, hey, let's bump this up. Now, once I got everybody's like, oh yeah, I'm going to go into the savings. Look, they're paying 5%. I can do 5% during these times of uncertainty. And then I would say, oh, okay, now I got your money. Guess what? You can't get it out. You see me? So some of these ideas on YouTube, when I tell you the market's going to do this, if you're, kind of on the frequency I am, you probably look at it and go, oh my God, but isn't the market going to crash? Yeah, man, it is, but not the way people are talking about it because they don't have the right information. This is a much more likely scenario. And then I'm going to wrap it up because I'm at a half hour, sorry. But look, man, the real scenario, the real danger doesn't really come in for the average citizen until 2024 is going to be the real moment of truth, because you come down to these levels, and this is what you should be worried about. I'm not worried about any of it because I'll make money either way. But if you're an average person, this duration, and last year when I was saying get your money out of pensions and talking to my dogs and my cabinets in my kitchen about it and saying I don't understand why people aren't getting their money out of their pensions, I was talking about this idea of a time burn. And I was saying that if you have money in a pension and that pension comes down, in order for the market to recover here, you could have a period of years, right, where the market stays trapped because there is deflationary pressure from the fact that there was this deep recession. So this is a deep recession. And then you got the guys that are like, there's going to be depression, and there could be. There could be, and that would be longer and deeper, right? This is the period of time. This is why you do your gold and silver and real estate. But this will also be the time, if you have cash on hand, you don't buy gold. Everybody's like, buy gold. Gold, I'm sorry, I just got to keep going because this is just stuff that's been on my mind and I haven't done a video in a while. So everybody's like, buy gold, and gold is a good investment. But if you're just looking, if you've been doing it all along, then you're not even watching this. But if you're looking to buy gold, if you buy gold here, I can promise you, I have 100% certainty that gold is probably going to hit this 148 range. January, February. Gold is going to come down as the market comes down. You know what I'm saying? Gold could hit 137. That's when you buy gold. Not while the market's here, unless you're like, on a different schedule. But if you're just looking to get into it, you got to wait a little while, maybe 150. That seems like that's a good range, right? And that's this is the paper gold, but this is spot price. So spot price on gold, I really got to stop, but all right. So spot price on gold, we've already hit the 1,614, but in a bad market, 1,500, right? So if you're not already doing it, you're getting all anxious, like buy gold, because you see all these YouTube videos. Well, do what you want, but you're going to lose money on it in the short term. Will you make that money back? Yeah, but why not just wait a little while for the market to crash and then buy your gold then? Anyway, my friends, I hope that helps, and keep on keeping on.